Good afternoon, everybody. This is Scott Palmer, Executive Officer of the Builders and Remodelers Association of Greater Boston. Welcome to our Wednesday webinar. Today, our title is What Tax Reform Means to You and Your Business. This will be presented by Mr. Bill Rucci, CPA and Managing Partner of RBF Advisors and Accountants in Woburn, Massachusetts. I will be recording this seminar. I'm going to give control of the slide deck to Mr. Rucci, who will be making his presentation. You are able to put questions into the chat window, which we'll be glad to ask at the end of the event. And also, we will unmute phones, or you can unmute your own phone to ask Mr. Rucci any particular question. With that, I'm going to turn over the presentation to Bill, and I look forward to the presentation. Thank you.
Hello, everybody, and Scott, thank you very much for that kind introduction. As Scott said, my name is Bill Rucci, Managing Partner of RBF Advisors and Accountants. We are a CPA firm that specializes in construction accounting and with many clients in the construction industry. And we've been doing this for more than 30 years. What I'm about to present to you is our presentation on the Tax Cut and Jobs Act of 2017. So with that, what we'd like to discuss is really some of the very specific provisions, not all of the provisions, but the provisions that I believe would be most useful for you and your business. Having made this presentation before with other construction clients as well as other construction trade associations, the items I have here are not all-encompassing with every single provision of the new Tax Act, but the ones that we believe that we've seen the most with the clients that we act and represent. So what you're going to see are just some selected, what we call selected individual and business provisions. And then really at the end of the presentation, and as we go through this, we're going to talk about those planning items that you really need to consider and what your to-do list is after this conversation. But just a few words about the new Tax Act. It is clearly the largest tax act since 1986. It's the second largest one in my practicing career, having practiced for more than 35 years. But unlike the 86 Act, it is not revenue neutral, meaning that there's an awful lot of big giveaways from a tax perspective. And I will tell you that the tax giveaways are most beneficial to small business owners. And when I mean small business owners, I'm talking about companies that are generally under $100 million in revenue. It generally lowers most taxpayers' tax obligations, and I'll show a slide about what I mean by that. The regulations for many of the provisions, while some have been drafted, many are still not there. And in fact, as you'll see as we go through some of the provisions when I talk about them, you're going to find out that that there are still a lot of what ifs or facts and circumstances, or it hasn't been tested yet, or we're going to have to wait and see how the government is going to react to some of the positions that I know that some of the businesses are taking out there. Some of the positions, quite frankly, we're taking with our clients as well. So with that, let us get started. We can talk about the impact on personal taxes. So starting from 2018, that is this year, to 2025, your tax rates have decreased. I won't read all the numbers or the percentages there, but on average, you can expect at least a 2% lower tax rate compared to 2017. What's not affected are your capital gains tax rates. The old legislation or the previous legislation of 0, 15, and 20%, that has not been moved. That is in place and it continues to be the same as it was prior to 2018. The 3.8 net investment income tax has not been repealed. You might remember that was introduced, and that's what's more commonly referred to as the Obamacare tax. That has not been repealed. A benefit that I think some of you will see is the alternative minimum tax, the AMT exemptions. They've increased to the numbers that I present on the screen. What's interesting?
Excuse me, Bill. Could you show your screen, please?
You can't see it?
Negative.
Okay. No, it's gonna be this one here. Can you see it now?
One moment. I'm sorry, the middle circle on your navigation should be green. The screen circle.
The screen. Oh. Shit.
You gotta click share.
How's that?
We're good.
We're good?
Yep. Thank you.
Okay. You can see impact on personal taxes. Is that what you can see?
Correct. You're up.
Okay, great.
Up and running.
Great. Fantastic. So in terms of other provisions that are going to affect your personal taxes, the individual health insurance mandate after 12/31/18, what we call the shared responsibility payment for individuals, that no longer applies. The standard deductions have increased to $12,000 for single and married filing separate, 18 had a household, 24,000 for married filing joint and surviving spouse. The personal and dependency exemptions have been repealed. For those of you who are thinking about getting divorced, the alimony deduction has been repealed for divorcees, divorce agreements executed after 2018. So if you're thinking about getting divorced and you're thinking about getting a deal struck, you might want to get that done sooner rather than later. In terms of your mortgage interest deductions, the interest deduction limitation was reduced from the existing one from 2017 from $1.1 million to $750,000 for any debt incurred that is acquisition indebtedness incurred after December 15th, 2017. The interest for your home equity indebtedness other than home improvements will no longer be deductible. Fortunately, the pre-12/31/2017 debt is grandfathered, and these rules have been effective for the years 2018 to 2025. What's also good news by the way of your personal home is the changes any changes with regard to the exemption under Code Section 121. That's the exemption that you enjoy when you sell your personal place of residence. Remember the rules where you have to live in the house 2 out of the past 5 years, and if it's your principal place of residence, married filing joint, you can exclude up to $500,000 of that gain on the sale of your principal residence, $250,000 if you're single. The final bill did not make any changes to this code provision, which is actually a very good thing. Unfortunately, there have been some limitations, and probably one of the biggest limitations that we've seen, and one of the biggest issues that we faced last year getting into last year's tax season was, what do I do about my state and local income taxes? They have been limited. Real estate taxes, state income taxes, your personal property taxes have been limited to $10,000, period. And I know that will affect many people as they file their 2018 tax return. Personal casualty losses have been limited. They are now only allowed where they have been declared under federal disaster recovery. In terms of moving expenses, temporarily repealed. So if you have moving expenses for your job, they have been temporarily repealed, and you will not be able to get a tax deduction for that. With regard to your itemized deductions, the overall limitation has been suspended. For those of you who were getting your itemized deductions limited in the past, 2017 and prior, there was a code provision where they said if your adjusted gross income was over $300,000, anything over that would be reduced or reduced by 3%. That overall limitation has now been suspended. So there is no limitation on your itemized deductions except for the ones that we've talked about with respect to your taxes and the other ones that we will be talking about. With regard to your charitable deductions, the limitation has been increased. When we say limitation has been increased, what we really mean here is your AGI limitation. So if your AGI is $100,000, you're limited of taking $50,000. We're allowed to take up to $50,000 of charitable deductions. You're now allowed to take up to $60,000. So it's the 50 to the 60 from the 50%. With regard to your medical expenses, while many people haven't been able to take medical expenses just because of the large threshold that you have to exceed, that has been reduced from 10% to 7.5%. It is only a 2-year period, and it goes back to the 10% after 2019. With regard to your miscellaneous itemized deductions, this is sort of an interesting thing. The government has decided to basically repeal all of the miscellaneous itemized deductions that you were enjoying prior to 2018. Those expenses would be things like tax preparation fee, your estate planning, personal estate planning fees that you pay for, employee business expenses. How about investment interest? How about investment fees? Those are no longer deductible. Union dues are no longer deductible. So all of these miscellaneous itemized deductions have been repealed. Estate and gift tax. As most of you probably know, there is a unified exemption that one enjoys at the federal level. That has basically been doubled from 5 million to 10 million per individual. And now that basically is adjusted and tied to inflation. So that number now is $11.2 million per person. That means that if you're married and filing a joint return, you now have a combined exemption of $22.4 million that you can exempt out of your estate. Meaning that if you've got assets that are less than $22.4 million married filing joint, that you will not have a federal estate tax. The rules, however, haven't changed for the state of Massachusetts. That still sits at $1 million. So estate planning is still alive and well for those of you who need an estate plan. If for nothing else, you need to have it done for the state of Massachusetts. Qualified tuition programs. You might remember under Code Section 529, if you funded a 529 plan, the monies in the past could only be used for post-secondary education. The new rules allow up to $10,000 a year to be used for private, public, religious, elementary, or secondary school. Secondary school is essentially a high school. So that's actually a big win, I think, for people who have young children or who have, grandparents who have set up 529 plans for their children or their grandchildren in this case. The child tax credit, that has been an increase. And has increased $2,000 per qualifying child. What's also increased is the threshold the threshold that has gone up to $400,000 married filing joint and $200,000 for all others. You'll see in some of the examples that I'm going to run that this child tax credit is in many ways the savings of tax benefit for married filing joint individuals. Opportunity tax zone incentives. I guess I'm hoping that some of you have seen this, but if you haven't, it's actually worth taking a look at. The opportunity zone incentive was created under the 2017 Act. And basically what it does, it's used to encourage investment in distressed communities through capital gain tax deferral, and in fact, in some cases, capital gains exemption. There has been almost 9,000 communities that have been designated across the country, and those have been defined by the government. I have a list, if you'd like, a copy of all of the communities that have been identified and designated in Massachusetts. Some of those communities, I think you'd be surprised. But the point is this, is that it applies to all pass-through entities who elect to defer their capital gains, and they must create a qualified opportunity fund. And at least 90% of the assets that are in the qualified opportunity zone fund effectively have been invested in qualified property. So in front of you is a list or a graphic of what it means to take advantage of this code section. What I'd rather do, the next slide, is go through a specific example of how you might want to think about this with some of the monies that you have in a way of getting tax, both tax deferred as well as tax exempt savings. So let's go through an example. Michael sold a business for $12 million and had capital gains. Michael located 2 properties in 2 qualified opportunity zones, QOZ, with total purchase price of $12 million. He then created a limited liability partnership as his qualified opportunity fund, QOF. If Michael holds the QOF for 7 years, he will pay a total of $571,000 in federal tax compared to what he would have otherwise paid at the date of sale of $671,000. If Michael then sells after 10 years the gain on the sale of the properties in the QOF, he will then have it be tax-free. So what does that mean? It means that on the original sale that Mike had with the sale of his business of $12 million, he would have been able to defer the gain on that sale of $12 million and pay essentially 5% of 15% on the capital gains that would otherwise paid at the date of sale. So he's been able to defer that for a period of 7 years with no penalties and no interest. And then when he liquidates the sale of his investment in the QOF, he pays no tax on the sale of the property that's in the QOF. So 2 things, again, deferring the gain on the original sale of his $12 million and then reducing and having no tax on the final sale of the property that's in his QOF. Very, very powerful opportunities for those of you in the real estate industry, specifically for those of you who like to develop real estate and can save significant tax money here. Let's do a couple of case studies. Now, what's important to remember about these case studies is that there are many, many case studies that I could do that have a bunch of different variations. What I try to do here is give you some of the more basic ones to just give you a flavor of how the tax code or the new tax code is actually working. So the first one here is a single individual. They have no itemized deductions. They have adjusted gross income of $100,000 in both 2017 and 2018. They have no itemized deductions. They have a standard deduction of $6,350 in 17 and $12,000 in 18. No personal exemptions in 2018 like they had $4,200 in 17. The taxable income, therefore, in 2017 was $89,450. It is $88,000 in 2018. The tax before any credits is $18,101 in 2017, and the taxes in 2018 are $15,410. That's a savings of about $2,700, but you can start to see how some of the items, like a higher standard deduction, whereas somebody who doesn't itemize their deduction is actually getting a tax benefit. Also layered on top of that is the fact that the overall tax rates have been reduced on average by about 2%. Next example, married with children. 2017, 2018, adjusted gross income of $100,000 for each year. In 2017, the standard deduction was $12,700. In 2018, the standard deduction was $24,000. The itemized deductions in 2017 were $24,000. That's $12,000 for the mortgage interest and $12,000 for the property. In 2018, there's $22,000 that's allowed for the itemized deductions. Again, the property taxes are limited to $10,000. So the $10,000 plus the mortgage interest of $12,000 limits the itemized deductions in 2018 to $22,000. 2018, there are no personal exemptions. There are personal exemptions 2017. What you therefore get is taxable income, big difference, $59,800 in 2017, $76,000 in 2018. Tax before credits is $8,038 in 2017, $8,739 in 2018. But where the married couple saves on their taxes, like I mentioned before, is on the child's tax credit. Here, because their income is less than $400,000, they enjoy the tax credit of $2,000 per child, which is $4,000. Under the previous law, it was only $2,000. That's a savings of about $1,300. And again, you can see some of the moving parts under the new tax act do affect the overall tax obligation. in this case for the married filing with children. Head household, again, $100,000 in both years. Standard deduction $93.50 in 2017, $18,000 in 2018. In terms of itemized deductions, $16,000 in both years. Personal exemptions, nothing in 2018, $12,150, in 2017. Your taxable income, therefore, in 17 is $71,850. In 2018, it's $82,000. Tax before credits is $12,215 in 17, $12,588 in 2018. Again, tax credits, because they have 2 children, head of household, fully allowed the child tax credit of $4,000 compared to the $2,000 in 2017. So the tax savings here is about $1,600. Again, you can see how the taxes are affected. In this case, married with children, or at least head of household with children, is going to be getting the benefit of the tax credit. Retired, $80,000 of income, standard deduction of $15,300 in 2017, $26,600 in 2018. Again, because it's a retired couple, both 66 years old, the standard deduction is increased because they are over 65 years old. In this case, there is no personal exemption in 2018 like there is in 17. Well, the taxable income is actually lower by about $3,000 in 2018 compared to 17. Total tax before credit is $75.57 in 17. 2018 is $6,027. That's a savings of about $1,500 on a retired couple making $80,000 with no itemized deductions and no mortgage interest and $12,000 worth of property taxes, but again, no itemized deductions that exceed the $26,600. Okay, let's talk about the impact on businesses, and this is where I think it gets interesting, especially the last bullet, conduit pass-through businesses, which I'm assuming many of you, if not all of you, are in this category. Very high level. Corporate tax rates, as pretty much I think everybody knows, are now down to a flat rate of 21%. The old rates were anywhere from 15% to 35%. The government basically said, let's make it a flat 21%. Net operating losses, again, if you're this is a C corporation, net operating losses are limited to 80% of taxable income. You can carry any unused losses forward indefinitely. There is no longer a carryback, 2-year carryback provision under the new law. If you are a C corporation and you did have losses in 2017 or 2016, and you do need, and there is a limitation going forward, there is clearly a limitation going forward, I strongly suggest that you relook at your taxes and maybe see if you can carry some of these losses back, because that 80% limitation will affect you going forward. The dividend received deduction has been reduced from 70% to 50% and from 80% to 65%. Essentially what that means is that if a C corporation owns investments, stocks, for example, in Apple or in Google, and they receive dividends, those dividends are tax-free up to, the old law was 70%, now they're down to 50%, but those dividends, investments in equities, have been reduced. The taxation of those dividends have been reduced. The alternative minimum tax has completely been repealed for C corporations, unlike the individual where the phase-in has been increased, which is a benefit, but at the C corporate level, the alternative minimum tax has been completely repealed. All of this is effective after 12/31/2017. Excuse me. The question that I've been getting from a lot of our clients is, should I convert my conduit or pass-through entity to a C corporation? And I will tell you that, having run these numbers a lot of different ways, in most cases, the combined tax rates of a C corporation, including the distribution of profits, what we call dividends, they exceed the single tax rate of a conduit or pass-through entities. Let's go through a couple of examples just to give you an idea. Now, Understand that, again, this is a C corporation. This is federal tax only. So I do not take into consideration state income taxes. If I took into consideration state income taxes, in a pass-through entity, that would be a rate of 5.1% in Massachusetts. In a C corporate setting, the corporate tax rate in Massachusetts is 8%. So there's about a 3% higher C corporate tax rate, but none of my examples takes into consideration the state income tax rates. So if on the left-hand side, I give you an example, marginal rate example, taxable income, $415,000 to $479,000, married filing joint, your tax rate is 35%. I do not take into consideration the new code section 199 capital A deduction. That's the QBI 20% deduction. I'll talk about that later, but just straight up not taking that into consideration, my effective tax rate is 35%. On the right-hand side of the screen, if I am a C corporation, my corporate income is $100. My flat tax rate is 21% or $21. My net to the corporation is $79. Then I distribute that $79 out to the shareholders as a dividend. That's an effective rate of 18.8%. That 18.8% is made up of two components: 15% 15% qualified dividends tax rate, plus the investment interest expense tax rate of 3.8. So that's 15% plus 3.8%. That gives us 18.8%. You subtract that from the total net to the shareholder, and their effective tax rate is almost 36%. So we compare the 36% tax rate at the C corporate level to the 35% at the pass-through individual level. Next example, we raise the income. Same example. Effective rate on the left-hand side for the pass-through is 35%, where a taxable income is $479,000 to $600,000. C corporate level, 21% flat tax rate, net to corporation $79. Dividend to the individual stockholder is $79. The shareholder income tax now is 23.8%. Why? Because the individual rate, taking a dividend at a taxable income of $479 to $600, is no longer 15%, it's 20%, because you've gotten to that highest tax bracket, plus the 3.8% gives us the 23.8%. The effective tax rate, therefore, in a C corporate setting is almost 40%. Again, I have not taken into consideration the effect of Massachusetts. Had we done that, pass-through would have been subject to a rate of 5.1%. C corporate in Massachusetts would have been 8%. And then finally, if we get the individual taxpayer married filing joint over $600,000 in taxable income, they get to the highest tax rate of 37%. You can see on the left, 37%. On the right-hand side, C corporation, 21% flat rate, 23% qualified dividends tax of 23.8. Their effective rate is the 39.8, effectively 40% compared to the 37%. Again, in all three examples here, it does not make sense to convert to a C corporation. A couple of other comments I would like to make if you're thinking about doing this. First things first, if you're thinking about doing this, run the numbers, because I don't think that you can make this, do this exercise in a vacuum. It can't be on a what if. You got to actually look at your numbers, where you are, where you think you're going to be, and actually run the numbers. It's not that difficult to do. I can tell you we've been doing it with many of our clients because we get the question all the time. The other thing I think you need to consider is the upcoming elections. I do believe that if Congress does change and the Democrats win over Congress, that may have an effect on this 21%. I do believe that the 21% becomes low-hanging fruit for people who are thinking that it's currently already too low at 21%. So tweaking this up 21 to 25 or 27% is not that difficult to do. which if that's going to happen, and maybe you just wait a little bit longer before you make your decision, depending upon what the current elections, the upcoming elections, what the results are, that could change your decision altogether in converting to a C corporation. Okay, let's talk about some bonus depreciation, some of the real benefits that we're getting out of this new tax act. Hopefully everybody's aware of bonus depreciation. We like to refer to as 168K. That was the old rules used to say that you were able to take 50% depreciation, 50% of the cost of the assets in the first year, provided that it was original use property. The new rules basically state that you can take now 100% of the cost of the assets, and it can be not only original use, but also it can be used for used property as well. That's a huge benefit. And that's for assets that have been placed in service after September 27th, 2017. There is a phase out. So this is available through 2022. And so after that, it's going to start to phase out 20% per year. So by the time we get to 2026, there's not going to be what we call a bonus depreciation, Code Section 168 available. But again, this is, you buy an asset, first year, new or used, you can write off up to 100% of the cost of that asset. No limitations. The other thing you need to keep in mind is that this is effective for assets purchased after September 27th, 2017. So my planning tip here is review your tax returns where you filed a fiscal tax return for years ending 9/30, 2018, 10/31, 2018, 11/30, 2018, and also 12/31, 2017. These are benefits that you will be getting. Also, 9/30, 2017, 10/31, 2017, 11/30, 2017. If you purchased assets after September 27th, 2017, and you haven't taken advantage of these new rules, go back, file amended returns. It's absolutely worth it. Luxury automobiles. The only comment I really have here is that the limitations of the maximum allowable depreciation has gone up significantly. So if you're buying luxury automobiles, Code Section 280F defines what a luxury automobile is. Go back, take a look at that, because I do think that there might be some tax benefits that you could get there for any new assets that you purchased after 2017. Code Section 179. Hopefully this is not a code section that I have to remind you of. Many of you probably use it. I know we use it a lot for our clients, in addition to the bonus depreciation 2 slides ago. But Code Section 179 expensing election was the old rules used to say that you could take up to $500,000, provided that you bought no more than $2 million worth of new or used property. The new rules now say that that increases from $500,000 to $1 million, and it is indexed for inflation, provided that you buy or invest in property that's less than $2.5 million. So again, if you're a business and you bought less than $2.5 million of new equipment, you can expense up to $1 million of that 2.5. Couple that with the bonus depreciation of 100% of first year new and used assets. That's very, very powerful tax planning when filing your 2018 tax returns. The other thing that's really important to note is that the Act expanded the definition of qualified real property to include Section 179. And what that means is that for non-residential real property, basically commercial real property, you can now use Section 179 for things like roofs, heating, ventilation, air conditioning property, fire protection, alarm systems, and security systems. So they not only have increased the expensing or double the expensing election from 500 to $1 million, they've also increased the assets that you can include in that $1 million limitation. Deductions and credits. One of the items that is not necessarily a benefit for pass-through conduit entities is the fact that if you've got aggregated deductions, losses related to a trade or business, and if you're married filing joint and they exceed $500,000, you will not be able to take a loss, combined loss from your conduit or pass-through entities, S corporation, LLC, partnership, or trusts. You will not be able to take a deduction greater than $500,000 married filing joint. If you're single, that loss is limited to $250,000. Any unused deductions or losses are carried forward. But remember that carry forward loss is limited to 80% of the taxable income in the future years, without regard to deduction of other NOLs. So that means that you may have lost $1 million in some of the businesses that you have, and you add them all up and you've lost $1 million. You're capped at $500,000 if you're married filing joint. You're capped at $250,000 if you're a single person. And that extra, the additional losses that you were unable to use in 2018 gets carried to 2019. You can use it against the income that's coming in if you have income in 2019. Any extra losses are capped at 80%. Okay. Meals, entertainment, office parties, summer office picnics, meals provided for the convenience of employers. Essentially, nothing's changed when you're dealing with things like office parties, summer outings, or picnics. Those, like the old rules, are 100% deductible. If you're entertaining clients, meals continue to be 50% deductible. That means that you need to, if you're taking out a client or a customer and you're talking about business, meals are considered to be 50% deductible. What are no longer deductible are event tickets, things like concert tickets, golf membership, tickets to qualified charitable events. They used to be 100% deductible. None of these are now deductible at all. One of the slides I'm going to talk to you about in a little bit is how you classify these slides, how you classify these expenses in your general ledger. Make sure you get a lot of granularity on your general ledger, because I'd hate for you to group some of the expenses that would otherwise be eligible, available under the 100% deductible that get clumped into the non-deductible categories. Employee travel meals continue to be 50% deductible. Meals provided for the convenience of employers. That used to be 100% deductible. Now they're only 50% deductible, and they are non-deductible after 2025. Interest deduction. If you have a business and your business has gross receipts less than $25 million, then there are no limitations on the interest that you can take as a deduction on your tax returns. If, however, you have a business and your gross receipts are more than $25 million, again, you have to meet the 25 million gross receipts test under Code Section 448C. Then you are limited to the interest of, you are limited in your deduction of your interest, and that limitation is limited to 30% of your adjusted taxable income. What's the effect? Highly leveraged companies with revenues over 25 million will experience limited deductions in interest expense. Again, if you fall into this category, I strongly suggest that you sit with your CPA and ask how to plan around this, because you can't plan around this specific code section. Accounting methods. Another very, very big opportunity here. The new rules basically state that if you're a C corporation or a pass-through or conduit entity, if your gross revenues are less than $25 million, you can use the cash method of accounting. What that means is this, is that if, let's say, you are a C corporation and your company was had $5 million or more of gross revenues, you were required under the old rules to be on the accrual method of accounting. The new rules have now increased that from 5 million to 25 million. And there were other rules under the same issues with flow through S corporations or LLCs that had lower limitations and required companies less than 25 million in revenue to be on the accrual method of accounting. The new rules now have expanded the use of the cash method of accounting to include all C corporation and pass-through entities with revenues less than $25 million for 3 years prior to the taxable period to use the cash method of accounting. My suggestion here is this, is that go through, look at what method of accounting you're reporting your income on all your tax returns. Make sure that you're using the proper method of accounting. Using the cash method of accounting usually results in a greater ability to control your taxable income when filing your tax returns. Planning opportunity. If your company's revenue exceeds $25 million and you could be running into the fact that you might have to use the accrual method of accounting, you might want to restructure your companies using a series of limited liability companies, taxed as partnerships, to stay under the $25 million threshold. What I mean by that is if you can break your company into different sections and get them all under so that the combined group is under, individual companies are under $25 million in gross revenues, that might be a way around of continuing to use the cash method of accounting for each of those companies. But combined, you might be required or might have to use the accrual method of accounting. Like-kind exchanges. Most of you don't know this, but when you go and you take a piece of what we call tangible personal property, cars, aircrafts, trucks, equipment, and you take that truck, that car, that piece of equipment, and you trade that in the past, prior to 2018, you never paid taxes on that trade-in because essentially what your accountant did was they rolled the gain into the new piece of property that you used to buy the new piece of property in the trade-in. Essentially, you're allowed to defer the tax on that trade-in. That rule no longer applies to tangible personal property. You can still use Code Section 1231 for real property, meaning that you can do like-kind exchange for real property, but you can no longer use it for tangible personal properties. What does that mean? What that means is that when you go to trade your vehicle or your piece of equipment, you now have to report that trade-in as a potentially taxable event if you've previously expensed the full amount of that vehicle, that aircraft, that car, that equipment. So that could create a tax for you. Okay, the meatiest part of the new Tax Act, and the one that I think applies to most of you, is the new Code Section 199A. Code Section 199A essentially limits Code Section 199, what we call the DPD or the DPAD, Domestic Production Activity Deduction. I will say that if you haven't been using, prior to 2018, if you haven't been using the DPAD, you might want to go back and look at your prior tax returns to see if your accountant has been using them. Because I've seen in a lot of cases where we've picked up business that construction companies who have been eligible under the old Code Section 199, they weren't necessarily taking it. So go back, file amended returns if you can. It's worth taking a look at. So for tax years beginning 12/31/2017, but before 1/1/2026, an individual taxpayer, again, pass-through only, not C corporation, may deduct 20% of what we call QBI, qualified business income. There are various phase-outs and phase-ins, and I'm going to try to make this as painless as possible for you. But first, let's talk about some important provisions. The Code Section 199A qualified business income deduction starts in 2018 and ends after 2025. Deductions reduce income subject to federal income taxes, but it does not affect self-employment taxes. What does that mean? If you're an LLC being taxed as a partnership, your flow-through income may benefit from the 20% deduction from an income tax standpoint, but it will not reduce your self-employment taxes. Your QBI is determined for qualified trade or business. That is U.S. qualified trade or business. And there is no AMT add back for this 20% potential deduction that you may be receiving. Rental property owned, whether it's commercial or residential, the passive activity rules don't apply. That means that if you're considered to be in a passive activity, you might be able to take the 199A capital 199 capital A deduction. Self-rental properties, it qualifies. What's a self-rental property? Well, let's say you're a wholly owned company, operating company, construction company, rents its office space from a wholly owned, you own a business that owns a piece of real estate. So your LLC rental company rents the space to your LLC or S corporation business. That's considered self-rental. If your self-rentals increase or include an income, you are eligible to take that 20% potential 199A deduction. Triple net leases may not qualify. So a word of caution here is be careful how you structure your leases. Triple net leases will not qualify in taking the 199 capital A deduction. Hobby losses, if you're considered a hobby, you will not qualify under 199A. Okay, let's talk about in graphic format what the rules are. I will spend a little bit of time going over some of the details, but just please bear with me in what you see here in terms of this next slide. This is essentially in one slide what the rules say. So on the left-hand side, it's a domestic qualified business. That is, it's got to be a U.S. business. It can't be a foreign company. So if you have taxable income less than 350, taxable income, not adjusted gross income, taxable income less than $315,000, married filing joint, 157.5 as a single, and you're considered, move to the right, if you're considered to be a non-service business, then you're eligible for a 20% deduction under code section 199A, and that deduction is essentially the lesser of your combined QBI, 20% of QBI or your taxable income, the lesser of your QBI or your taxable income. Don't worry, I'm going to give you some very specific examples. We're going to run through these and you'll get an idea about how the new law works. If you're considered to be a specified service business, and we'll define that in 1 minute, then again, the same rules apply. So first look at your taxable income. If you're married filing joint and your taxable income is $315,000 or less, then there's a very good possibility that you're going to be taking some, if not all, of your 20% QBI deduction. If your income is between $315,000 but less than $415,000 and you're a non-service business, then there is a limitation phase-in. We'll talk about that in a minute. If you're a specified service business and your income is between $315,000 and $415,000, married filing joint, then there is a phase-out of your deduction. By the time your taxable income exceeds $415,000 in a non-service business, you now have basically 3 tests to go through. 20% of your QBI, 20% of your taxable income, and then the greater of the two, 50% times W-2 wages and what we call our capital limit phase-in. I will go through an example of what it's like in 1 minute. Your specified service business, if you are considered to be a specified service business and your taxable income married filing joint is $415,000, or if you're a single person, and your taxable income as a single person is $207 or more, then you cannot take and you are not eligible for your QBI deduction under code section 199A. Okay. So in our previous slide, I talked about under a non-service business, that what we call that phase-in, that limitation phase-in. What is that W-2 and capital requirement? Okay, that third phase-in is basically taking the greater of 50% of the wages that are reported on your business's tax return, or again, the greater of 25% of the W-2 wages plus 2.5% of your adjusted basis of your equipment or your other fixed assets like real estate. So it's a third element in determining whether or not you can take Code Section 199 capital A deduction. And again, I'll run through an example of what that looks like. So QBI is the net amount of qualified income, gains, deductions, and losses, like I said, with a qualified U.S. trade or business. And the definition of a specified service business is any trade or business involving the performance of services in the field of health, law, accounting, actuarial services, performing arts, consulting, athletics, financial services, brokerage, or any trade or business where the principal asset of such trade or business is the reputation of or skill of one or more employees. One profession that has been excluded from this specified service definition are engineers. Engineers are not considered to be a specified service business. That means that you fall under the bucket that you're a non-service business. That's important, especially if you're a construction contractor and you're offering engineering services. Okay, let's talk about the de minimis rules. Let's say, for example, that you're considered to be a specified service business. You're not an engineer and you meet all those other tests that I just mentioned. If your gross revenues are $25 million or less than $25 million, excuse me, then the government will still allow you under the de minimis rule to have up to 10% of your income to be from a specified service business and still qualify for Code Section 199 capital A. If your business has revenues that are greater than $25 million, you're allowed up to 5% of your income to be considered to be a specified service business and still qualified for Code Section 199 capital A. Okay, let's talk about concepts. W-2 wages. Again, this is the third leg, non-service business. This is the W-2. This is the W-2/capital requirements or qualified property requirements under the third prong, what we call the phase-in, limitation phase-in. W-2 wages are included in the calculation. That includes all wages paid to employees, even to officers, owners of the business. It does not include guaranteed payments to partners or independent contractors. And that's something you need to think about if you're structured as an LLC and you're a member of that LLC and you decide to take your money out through a guaranteed payment. By doing that, you are essentially limiting the amount of 199A deduction you can take. Again, if you're structured as an LLC and yet you're a partner and you're taking your money out as a guaranteed payment, you will be limiting your 199A deduction if you continue to do that. Compared to, example, if you're a S corporation and you're an owner of the S corporation and you have to take your money out as a W-2 employee, that actually works to your benefit. We'll talk about converting from an LLC or a partnership to an S corporation in 1 minute. Qualified property. Tangible property held by and being held for use in a qualified trade or business, it does not include land, then you're allowed to take a 2.5% deduction for 10-year on property that's considered tangible personal property and with a useful life of 10 years or less. If the property is residential real estate, it's got a useful life of 27.5 years. And for property that's non-residential, i.e. commercial property, it's 39 years. So what does that mean? That means that if I bought an asset, if I bought a piece of equipment and I bought it after 2008, for purposes of making my 199A calculation, my 199A capital A QBI deduction, I can take any asset, again, younger than 10 years old, and use that as part of the calculation. If I've got assets, tangible personal property assets, that are 11 years old, 12 years old, 13 and up, then I am not eligible to use those assets in making the calculation for my QBI deduction. Same holds for residential real estate. If I've got a piece of residential real estate and it's older than 27 and a half years, then I can't use that property in my calculation under the QBI deduction 99 capital A. 39 years, non-residential commercial property. Any real estate that you own that's more than 39 years old, you can't use that asset in making the calculation in that third prong. So what do we mean by deduction, capital deduction? Well, my previous slide showed that it has to be on property for 10 years. It's got to be assets that have been purchased since 2008. But what is the basis from which we make that calculation? What is the 2.5% multiplied by? Well, it's multiplied by the basis at acquisition, meaning what you paid for it and all the capitalized costs that went into it when you bought it at acquisition. It is not the adjusted property basis accounting for depreciation. That's big. So if you bought a piece of equipment 5 years ago, you paid $100,000 for it, and you've already fully depreciated it, you're going to be able to take 2.5% on the $100,000 that you paid 5 years ago, even though the basis sitting on your books is after depreciation and is sitting at zero. Finally, the government has duly deputized the accounting profession and the legal profession, and basically what they've said is, listen, if you're going to go in and you're going to start to play around with some of these rules, and we find out that you're overstating these deductions, the 199 capital A deduction, then we are going to hit you as well as the taxpayer with a 5 to 10% overstatement penalty. Keep that in mind. Okay, so let's go, as promised, let's go through some of the very simple examples that I have here. Hopefully it'll make it a little bit clearer for you as to what I'm talking about on those previous slides. Example A. Jack is a married contractor. He has a combined QBI, qualified business income, of $100,000. His taxable income is $250,000. Calculation's easy, right? What I said was first determine what your taxable income is. Well, determine if you're considered to be a specified service business or you're a non-specified service business. Well, Jack is a contractor, so that means that he's a non-service business. His taxable income is less than $315,000. You take the lesser of 20% of his taxable income or his QBI. In this case, it's his QBI. So he gets an additional deduction of $20,000. Example 2, Paula is a married contractor. Her combined QBI is $250,000. However, due to tax losses, her taxable income is only $200,000. So you take the lesser of the two calculations. Again, Paula is a contractor, a non-specified service business. Taxable income is less than $315,000, so there's no phase outs or phase ins. You take the lesser of 20% of the QBI or 20% of the taxable income. In this case, it's the lesser of the taxable income, and her deduction under code section 199A is $40,000. Third example, a little bit expanded. Danny owns a demolition company and has taxable income of $500,000. So clearly, he's a demolition company. He's a non-specified service business. His taxable income is over $315,000. He generates $100,000 of QBI, qualified business income. He pays W-2 wages of $50,000. And all of his equipment, his qualified equipment, is old. He's held it for more than 10 years. So what's Danny's code section 199 capital A deduction? Okay, so we take the lesser of Danny's $100,000 QBI times 20% compared to Danny's taxable income of $500,000 times 20%. But because Danny is over, his taxable income's over 500,000, you now have to go into that third level, that third phase of calculation. So what do? We say, okay, we're going to take the greater of 50% of the wages paid, 25,000, or 25% of the wages paid plus 2.5% of any qualified property, which in this example is 0. So now we take the 25,000, comparing the 25,000 to the 12,500. We take the $25,000 and we compare that to the $20,000 QBI deduction of 20,000 and the taxable income deduction of 100,000. So the answer in this example is the $20,000 because it's the lesser of those three numbers. Okay. Okay. Now let's do an even larger calculation, a more expanded calculation. Jim, he's married. He's a 50% partner in Reswater Real Estate LLC. He has $750,000 of pass-through net income in 2018. Jim and his wife have $100,000 of other income, and will have $50,000 of itemized deductions. Additionally, Reswater LLC has $120,000 of W-2 wages and $4 million worth of unadjusted cost basis assets. Based on the facts, below is a summary of Jim's QBI. So his net business income is $375,000. That's 750 times 50%, because he's a 50% owner in the partnership. His other income is $100,000. That's a given. Adjusted gross income is $475,000. We take out his itemized deduction of $50,000. That's a given. So now we have taxable income of $425,000. Two things. He is a non-service business, and his taxable income is over $415,000. So we have to use all three phases in making the calculation for what his QBI code section 199A deduction would look like. Okay, so at the bottom, if you can see it, I made all the calculations for you. So I take the first calculation. 20% of the net business income is $75,000. I take the 750 times 50% times the 20%. That's the $75,000. The second calculation is 20% of the taxable income. That's $85,000, or 25 times 20%. Or I take the greater of 50% of the wages, $120,000, because he's a 50% owner. 50% of that is $30,000. Or I take 25% of the W-2 wages plus 2.5% of the adjusted basis of the assets, $4 million. And that gets me a $65,000 deduction. So now I compare the $65,000 to the $75,000 on my QBI deduction compared to the $85,000 of my 20% of my taxable income. And the answer is $65,000 as a deduction under code section 199A. Okay. So let's talk about planning. Just a couple more slides. The key here is this: you have to know your taxable income. So that means that you have to know where you are in terms of your timing of your income and your expenses. Again, that's incredibly important because you want to make sure that if you can be under the $315,000 married filing joint, or if you're a single, 157.5, that's going to be incredibly important to getting and wanting to know that getting to that 20% deduction straight away. More income and deductions, leverage could be problematic in reducing your QBI. And if you're a business that has more than $25 million in revenue, you could potentially be facing a limitation in deducting your interest expense. Purchased fixed assets is better in many cases than just leasing these assets. Why? Because leasing your assets will not get you that 2.5% deduction under that third phase of making the calculation if if your taxable income is more than $315,000, or excuse me, more than $415,000, or 2075 if you're single. Consider incorporating your sole proprietorship, partnership, or LLC, which may be currently taxed as a partnership, to a subchapter S corporation. I alluded to this earlier. Being a subchapter S corporation, you get to take as your compensation your W-2 wages. Those wages are used in that third phase in making your calculation for the 50% or the 25% wage calculation under the QBI calculation. If you're a sole proprietor and you take a draw, those draws are not considered compensation. If you have a partnership, and you're taking guaranteed payments, it will reduce your QBI, but you will not get those guaranteed payments as part of your W-2 calculation. So it's actually a double hit. So you have to think about how you want to take your money out of your partnership: distributions or guaranteed payments, or perhaps a combination of the two. Consider terminating your shareholders. If you're a shareholder and you've got a spouse as an employee, you'd want to calculate whether or not it's worth it to have he or she on payroll, even if there is that pension contribution that you're making on his or her behalf. The reduction in QBI may be a way, or may be something that you may not want to have your employee, your spouse as an employee on the payroll. Reduce, as I said, reduce your guaranteed payments. Guaranteed payments are not considered payroll, and therefore you will be reducing your QBI while at the same time not getting an offsetting 50 or 25% deduction, because guaranteed payments are not considered to be W-2 compensation. 1099s, contractors. Again, if you have 1099 contractors, you may want to consider converting them to employees, because 1099s will not be part of that W-2 calculation. So therefore, you would not be getting the part of the 50% or 25% W-2 deduction on that third prong with your taxable income over 415. Make sure your accounting systems are well organized with sufficient details. When I say see deduction and credit slide, what I mean by that is you want to make sure that you're parceling out, and I mentioned this before, with entertainment, with meals, make sure you're getting and breaking out those expenses that you can get either 50% or 100% deduction on. Clumping them all together will most certainly may result in you not getting any deductions, especially if your company is audited by the IRS. Confirm your industry, whether or not if you're a service business, a specified service business, know that limitation. Review your depreciation schedules. Fixed assets acquired many years ago, that may be problematic. You may have assets that are more than 10 years old, in which case you'd probably want to know that, because they're not part of that 2.5% calculation. If you've had cost segregation studies, we do many cost segregation studies here, but that may be problematic as well, because it may kick some of the assets out that have been keyed in as a 10-year property that may be kicked out of the calculation for the fixed asset, the fixed asset calculation of 2.5%. Review your chart of accounts for all your past due entities. More detail will result in additional deductions. And finally, improve leverage, improve intercompany accounting. Make sure that if you've got a lot of intercompany loans, with the reduction in the QBI and the limitation in your deduction of your interest expense, make sure you're considering all of the leverage between the entities that you're looking at. What you don't want to do is you don't want to have a situation where you're phased out of the QBI plus you're getting a limitation on the deduction of your interest. Looking upon how you can refinance that debt amongst your entities, in the way you're structuring your entities, may be a good exercise to go through. Review your shareholder and employee compensation plans. Again, you may want to limit your independent contractors, convert to employees. You may want to review your partnership agreements. Specify how your compensation is to be paid. Guaranteed payments or distributions. This is something that you probably want to memorialize if you want to stay this way, because if you do get into an audit situation with the IRS, they're going to look to these agreements to say whether or not you should have been making guaranteed payments or making distributions. And you want to err on the side of conservatism and say that they're considered to be distributions because, like I said, the guaranteed payments don't get you the W-2 deduction, and it reduces your QBI. And finally, what we're doing here with our clients, and we've been doing them since June, is taking your 2017 tax information, preparing an entity-by-entity analysis, and calculating your QBI. Then basically simulate 2017 tax reporting or projecting 2018 and overlaying that under the new tax law. That's where your planning begins. But you need to do it now before the end of the year, because if you don't, when the year is over, it's going to be difficult, if not impossible, to get all of the benefits that I just talked about. That's it. That's all I have. Scott, I'm not sure if, I know I am over by about a half hour, but I'm happy to take any questions either now live, or I can take them offline, either through email or through telephone calls.
Yeah, Bill, thank you. That was amazing. Amazing amount of information, very well organized and presented. Thank you. For right now, I will open up the calls. You all can either unmute your phone. Everything's unmuted. If you'd like to ask Bill a direct question, I'll take a moment and fire away. Bill, I do have a one question, more of an opinion. After all this has occurred, do you think that the new tax code is a simpler and better tax code for the country, or is the jury still out on that?
It's a good question. So I tell you this: I think that if you're an employee, you don't have a business. You have very little itemized, or very few itemized deductions, and you're married and have a few kids, or you're retired, then I think it's a much simpler tax code. But I think that that's a small percentage, and it's certainly not the population that we work with. I think that for businesses like our audience, I think that it has absolutely made life much more complicated. But I do think that this is a tax code that was written with the small business owner in mind.
Yeah, I think so. And the other question I saw, I think you already answered. It was basically, if you were going to start your own business, or you're in some kind of business, what is the best business class to be in? And I think I saw it would be a sub S.
Yeah, it's a good question. I can tell you that you've got to be very careful on what the type of entity that you choose, because it just can't be tax driven. It's got to be driven by the relationships amongst the partners and how they want to share income, how they want to share money. I can tell you that we have many clients that are LLCs that are taxed as partnerships, and they're staying that way, even under the new rules, because the flexibility that a partnership or an LLC taxed as a partnership offers in giving monies to the different partners in different ways, they enjoy that flexibility more than being a bit more restrictive under an S corporation. However, if it's a simple 1 or 2 person or 3 person company, you know who the owners are, you're comfortable with the split in income, then generally speaking, an S corporation is going to give you a better tax deduction under the new law. And it's just because of all the things that I mentioned previous. It's the guaranteed payment issue that you have to deal with under the partnership rules. You also have the issue of getting the benefit if you're a stockholder in an S corporation. You get to take a W-2. You're not allowed to take a W-2 if you're a partner in an LLC taxed as a partnership. That's a limiting factor. Right. But again, what I would suggest is having a conversation with your CPA. We do it with our clients every day. What is it that you want out of your business? I know you want tax benefits. I know you want the write-ups. I get it. It's important. But at the same time, having a certain level of flexibility amongst the entities is important as well. And it doesn't also mean that you have to have one entity. You could create 2 lines of businesses. You could create 2 companies, one an S corporation, one an LLC. and you can, really move income properly and legally amongst those entities by using the structures that make the most sense given what you're planning to do.
And finally, it's more of is there a question there? Okay. Finally, when the dust settles and it's all said and done, do you, in your opinion, and we won't hold you to this for sure, do you think this will ultimately generate more tax revenues for the U.S. government?
No. No. Like I said, and I didn't, and I don't think you saw one of my first slides. Unlike the 1986 Act, that was a revenue neutral act, meaning that revenues were increased to meet the reductions or the benefits that were given to taxpayers. This is not. This is deficit. This is a deficit-producing tax bill.
And then, as a follow-on to that, so is it temporary?
I think who gets into Congress, it very well could be.
Yeah. Okay. All right.
I just don't know. I don't know how they can fund. Quite frankly, if you think about the way what's happened, and I think about all the benefits that my clients are getting, I just don't. In my own world with my clients, most of which are construction companies, I don't know how the government. I don't know how the government's going to be able to continue to pay the bills that they have to pay with the decrease in tax revenues. Now, I do understand that to some extent, the growth in the economy will create more jobs and create more, therefore, more withholdings. That's yet to be seen.
Right.
That's
okay. Well, I mean, we could go on, but you've already broken the record for a webinar on Wednesday. Thank you very much. And several people have asked also for a copy of the presentation. Is it all right if we make that available?
Certainly. I'll send you the updated one, Scott. The one I presented on the screen is a little bit different than the one I've sent you.
Okay, that sounds good.
Okay.
All right. Thank you very much. I really appreciate it. And that ends our webinar for today. Thank you, everybody.
Thank you all.